Okay, so good afternoon, everybody. So it's time to get started. So we are nearing the end of the semester. Just a few more lessons about financial markets, money markets, and eventually during the last week we will have maybe 1 or 2 chapters of applied microeconomics, mostly dealing with the labor market. And that's the end. The final exam, as you know, is online, and I will provide you with all the requisite materials that you will need for that, including the study guide that you already mostly have. And that's that. So today we move to chapter 35 in the book, which I kind of mislabeled in these lecture notes. I wrote equilibrium interest rates. That's a mistake. It's actually the equilibrium in financial markets. The concept of market equilibrium in financial markets. Financial markets. So you already know, you'll see in a moment, that the concept of equilibrium is the same concept of equilibrium we know from the consumer theory and production theory. That's a situation in which all available knowledge was utilized and all needs of the consumers are satisfied. The equilibrium is a situation in which nothing happens, nothing changes. That's a changeless situation, no major change. Now, we know that equilibrium is never or very rarely something that actually exists. It's much more fruitful to talk about the tendencies towards equilibrium. So things always change. The information always changes. Preferences always change. The way how people satisfy preferences of consumers change. But there is a tendency towards elimination of those changes or accounting for changes, so there is a tendency towards equilibrium. We'll see in the financial markets, the concept of equilibrium is connected to risk. So the first, I'll write it down here. There are 3 concepts that we're going to study today. The first one is equilibrium. Related to risk and return. Risk and return. The second is something called efficient market hypothesis. Efficient market theory. Hypothesis. As the term hypothesis is used because it is a controversial piece of economic theory. Economist Eugene Fama of the University of Chicago, he developed this theory. And he got the Nobel Prize theory for the efficient market hypothesis, and something that follows from it is called random walk theory of financial markets. You'll see that the connection between these two is
What's the word?
rather random walk. Walk. Random walk. Sorry for my Slavic pronunciation of English terms. That's irredeemable. And when you start learning English at 23, there's no way you can eliminate. You can, if you're a Norwegian or a Dane or German, you can perfect English pronunciations. And I can speak Russian with almost no accent. That's a Slavic language. So there you have it. Random walk theory will explain what is the relationship between the two and why these two theories are controversial. Why efficient market hypothesis? Why is that hypothesis rather than a theory or a theorem. Sometimes when economists are pretty certain about something, they name the principle like a axiom or a theorem or a principle or a theory, so something that conveys the sense of certainty or confidence. Here it's hypothesis still. It may or may not be true. I think it's true largely, but not everybody agrees. Okay, so let's go back. I'll give you now a dogma, how the equilibrium, the concept of equilibrium is defined in financial markets, and then I will go step by step in demonstrating why is this the case. So you have in your book written that equilibrium happens when a competition between investors drives risk-adjusted returns to equality. So the concept of risk-adjusted returns are equalized. When this happens, we say that there is an equilibrium in financial markets. So obviously, in order to understand the concept of equilibrium here, you'll have to understand the entire lecture today essentially will be to try and make sense of the concept of risk-adjusted returns. What does that mean? And some implications of that. Here, return means like a rate of return. Rate of return on investment. So if you can say profit rate in a sense, precise sense. So you invest $100 and you earn after a certain period of time $115. So your rate of return is 15%. That's what it's meant. Now, why the concept of equilibrium involves the risk adjusted or risk adjustment of the rate of return. So that's our task to try and explain. So there are two concepts associated with risk that allow us, that help us understand this. The first is a mean, statistical mean. The second is variance. Anyone knows what is the difference? What is a mean in statistics? Yeah, average. So you have 10 different numbers, and then the mean would be the average number. In this particular case, mean means the average of all possible outcomes of a certain investment decision. Average of all possible outcomes, or all predicted outcomes. So you use a statistical model to estimate what's going to happen if you buy a certain stock. That's what financial analysts very often do. You predict. Starting from the imperfect and incomplete knowledge that you have, you plug the data in the computer, and then it predicts. The model predicts what is the likely expected rate of return. So then, in one model realization, it's 20%, in another is 13%, in another 8%, and so on. And you run the model 10,000 times, and then you average all the outcomes, and the average value is 13%. So that's your average rate of return on a mean, statistical mean. So that's one thing. What is the variance? That's the second important concept.
Like how widespread the data is? Same thing.
Yeah. So what do you mean by how widespread the data is? How wide the spread is. Not widespread means something that is all over the place, but how wide a spread is. The spread between what?
Like the highest and the lowest?
Highest and lowest, exactly. So variance is a variation. How tightly clustered all model realizations are, or how widespread. Why is that important? Why variance is important? Spread. of possible outcomes. Why is that important?
I guess in terms of risk, you can have like a lot of risk or like not very much risk, or it could just.
So what is the relationship between the variance and riskiness of an investment?
Like the more risky it is, like the higher or lower the variance is.
So riskier it is, variance is greater. So I'll give you one example here. Let's say this is $1 that you want to invest. Some kind of security, stock, or bond, whatever. And let's say that you do, 10,000 predictions based on a certain model, a certain knowledge that you have, and you average it out and you say the average value is 1.2. That's your mean. And let's say that maybe 15% or 20% of the time, model shows you this mean value. All other values are higher or lower. And now, let's see like a probability distribution curve. How many values are at different points? Let's say that here is 0.6, and here is $1.8. For every dollar that you invest, you're gonna get higher or lower value. Now let's say this is probability distribution, like a normal probability distribution. So lower this height of the graph, lower the probability. So here is like 25%. You might have maybe 1 or 2% to earn 1.8. It's a very high rate of return, but the probability of that is implied probability is very low. But notice what is weird here. It's a high mean value, so 20% is a high rate of return, but what is the price of that? The price of that is that you have maybe 30% chance or so that you're going to be losing money. So the variance is 0.6. The spread of possible outcomes is very wide. It's outside. You know what I say with the margin of error, like the difference between Biden and Trump is within the margin of error or outside the margin of error. You know statistical definition of that. But they call a race in the election. When the agents when they proclaimed Biden winning Pennsylvania or Michigan, what kind of statistical test they perform? They run a model. They take the data and program their model, and they run 10,000 times model. If it model shows 99.5% or more Biden winning, then they call the race. It's called 99.5 confidence interval. That means that less than one in 200. No, 1 in 2,000. 200. 99.5, so 0.05, 1 in 200. So that's a statistical test. Here, you run the model 10,000 times, and maybe 3,000 times you lose money. It's very high risk. So high implied rate of return. That means high possible profit is always associated with a very high variability and uncertainty. That means you can earn 1.8. You have 1 or 2% to earn 1.8, but you have 1 or 2 point chance that you're going to lose 40 cents on every dollar that you earn. And you might have maybe 10% chance of losing 30 cents on every dollar, or maybe 20% chance of losing 10 cents per dollar. So higher the mean means that the variance will be higher, so they're correlated. the rate of return is always, high rate of return is always correlated with a high uncertainty and variability. That's what we mean when we say that high risk investment has a higher return rate of return. And vice versa, you can imagine now another security. €1 here, let's say German government bonds, my favorite example for secure investment. So you will have a mean now 1.05. That's the mean value. It's very low. It's 4 times lower rate of return. And what is the catch? Look at the probability distribution. It looks something like this. You're not going to earn much more than 8 cents. It's very unlikely that you're going to get more than 8 or 9 cents per dollar. That's the tail of the probability distribution here. And it's lowest. But it's very unlikely that you're going to lose any money either. So I have this narrow range of probabilities, which means lower uncertainty. Uncertainty means that the implied expected probability distribution is less spread, implies lower mean. So that's the price of a higher potential rate of return on your investment is a greater uncertainty, which is mathematically expressed as a wider probability distribution or a higher variance of the mean, higher rate of variance. So it cannot be avoided. So this is kind of ironclad connection between mean and variance. They move in the same direction always. So you can have a higher rate of return, but the price that you always have to pay for that is higher uncertainty of the outcome, and vice versa. You want to have a safe investment? Yes, you can have it, but the price of that is a lower rate of return. So that's a kind of simple mathematical framework to demonstrate the character, risk compensating nature of the financial return. Financial return, the rate of financial return primarily compensate differential levels of risk associated with different securities. Now, is there anything that you can do to reduce the variance of your investment beyond choosing more secure, whatever, stocks and bonds, selling your junk bonds and buying German government bonds, selling whatever you're buying, Amazon stock or something? Looks like a safe bet. There are 2 mechanisms for reducing variance. You're familiar with them, probably. The first one is hedging. What is that?
Is that betting against the company?
Yeah, betting for and against at the same time. So one example could be, I think it's used in your book, it's a very nice one. You buy stocks in an airline company and stocks in an oil company. So whatever happens to the price of oil, you're going to minimize the risk exposure. So although the underlying risk of both investment is significant, your risk as an investor who holds both securities at the same time is dramatically reduced, because if the price of oil goes up, what happens? The value of your oil stock, let's say ExxonMobil stock, will increase because they are selling this stuff. It's more expensive, so it goes up. But what happens to your airline stock? It goes down because the kerosene oil is one of the main sources of cost. Higher the price of oil, higher the costs of operating costs of airline companies, so the value of stock, all other things being equal, should go down. So that's hedging your bets. The other way around, the price of oil goes down, Exxon stock will go down, airline stock will go up because their costs are now lower. So that's one way of kind of limiting your risk exposure. So you select your investment portfolio in such a way as to hedge your bets on different forms of stocks. The second approach of limiting the variance of the risk variance of your investment is diversification of portfolio. What is that? What is the proverb for this diversification of portfolio? Don't put all eggs in one basket. That's the idea. So what does this mean? What is the meaning in the context of financial markets?
Well, I suppose it's like you could buy stock in companies that are like, if one goes down, the other will go up. Like
okay, so yeah, that's hedging when they're directly negatively correlated.
Oh, okay.
But diversification is when you try to buy everything, to buy a large number of different stocks that are independent. You try to make a cross-section of the entire market. You try to make a random, according to the optimal portfolio theory that again Eugene Fama was instrumental in developing. What you want to do is to select, and that's the task for investment portfolio managers, to select a random sample of stocks that are independent, that represent the market, the cross-section of the financial market. So then, what is the assumption of this? The assumption is that these prices of different types of stocks are not correlated, that they're independent. Which means that the price of one of them will increase. That doesn't affect the probability that any one of the others will increase. The expectation is that on net, some prices will be going up, some prices will be going down all the time, but the general price level, the general stock market level will go up. And if your portfolio is nicely fine-tuned or nicely reflects the general tendency of the market, the value of your portfolio will go up. So it will be a wash. Some prices, not all prices in your stock portfolio will go up all the time, but on average it will be a wash. Some of them will go up, some of them will go down, but they're independent. So that's one aspect. The second aspect, you want to make a combination of different things in your investment portfolio. Stocks, a representative sample of the stock market, bonds, government bonds as a more secure investment, and finally some cash. Whatever, money market mutual funds or bank deposits and so on. Why is this gradation? Stocks, bonds, cash. Which is the most secure of the three? Cash. Which is the second most secure? Bonds. And stocks are the least secure. Why is that?
Cash you can always have on hand, or realize stocks change based on like how a business.
Yeah. Can you lose your cash? You put the cash in a bank. Why? Yeah, Federal Deposit Insurance. FDIC is here to bail you out. If a bank goes bankrupt, remember this moral hazard problem that we discussed. That Federal Deposit Insurance prevent you from losing money if you're up to $250,000. If a bank goes bankrupt, you're not going to lose your money. It was passed in 1930s as a means of eliminating the bank runs. So now cash is secure. Why bonds are more secure?
Less variability. They don't change as much.
Why? What is the difference? What is the basic difference between?
Bonds are long term. Like,
Oh, don't have to be. There are also short-term bonds.
They have a fixed interest rate,
Okay.
which is still dependent on the market. Like you know what rate you're gonna get.
Yeah.
And
What else? Lower rate. Which one has a lower rate on average? Stocks or bonds? Rate of return.
bonds.
Yeah, bonds. Why?
less risk.
What is the basic, like a legal difference between stocks and bonds? I buy $100 IOU. You're a corporation. I buy $100 worth of bonds, and I buy $100 stocks. What's the difference after a year?
You can completely lose the stocks, but bonds, your money still.
Yeah, you cannot lose bonds. That means IOU, whatever. If you don't have a profit, after 1 year, you're not going to pay your dividends. So stock is worthless. I don't get any money on account of stock, but yes, I still get the compensation for bonds. Money that is promised. So, the first in line, if a company goes bankrupt, who is first in line during the bankruptcy procedures to get the money? Bondholders. So that's why bonds are far more secure investment than stocks. Being far more secure, that means that the variance is less, and then the rate of return will be lower. So when you make your stock portfolio or your financial portfolio this way, you actually limit your individual exposure to risk. If you buy just stocks in one company and company goes belly up or loses profit, you're going to be losing huge amount of money. Here, it's far less likely that you're going to be losing money because you're diversified your investment portfolio, both vertically and horizontally. Vertical in terms of buying different kinds of stocks, and horizontally, or vice versa, by buying three different types of investment: cash, bonds, and stocks. So you don't want to be really risk averse. If you're really risk averse, your combination would be like 80-90% of bonds and cash, and then just a little bit of super secure stock. But then your rate of return will not be very high. So they have to kind of hedge a little bit to have some risk exposure, but not too much. Depending, again, not all investors have the same approach to risk. There is not one single method or a model how you should handle risk. But if your goal is to be risk averse, to lower the level of risk, then you're gonna diversify portfolio both horizontally and vertically as much as you want. There are speculative investors. There are people who think they know what should be done, who think they can beat the market, so they would invest in speculative stock. Okay. Any questions thus far? So you see then the profit rate or return rate is a compensation for bringing the market into the equilibrium. So what would be the equilibrium? The equilibrium is this situation in which a high rate of variance is associated, the high mean value or mean rate of return is associated with a high variance. and a low rate of return is associated with low variance. That's a characteristic of the equilibrium in financial markets. Which means in the equilibrium, less risky investment will give you a lower rate of return, and more riskier investment will give you a higher rate of return. What's going to happen if a combination of high rate of return, which means a high stock price, and low variance happens? What would that mean? Can you describe me what that situation would be?
Just an expensive bond, I guess.
Expensive bond, okay? What else? So you have a high mean value, very high rate of return, promised or expected rate of return, and a very low variance. That means actually misperception of risk. That people are thinking that something that is very risky. How do we know that it's risky? Because it's a very high mean value. It's a misperception of risk in which people underestimate the riskiness of a certain investment. So that's not an equilibrium. That's not a sustainable situation. So how the equilibrium will be restored here? By somebody discovering this information. Somebody discovers that it is far riskier than it is. What this person, if that person is a security holder right now, what she will do?
Sell.
Sell, of course. Why would you sell?
Easily lose money.
Yeah, because you think you know that the underlying risk variance is higher than now. That it is reflected in the current price. That is, security is far riskier than investors now believe. So you engage in what is called arbitrage, risk arbitrage. What is arbitrage? Earning on the price spread between the real value of an asset and the current value of the asset. So one way in which you can benefit from, you can engage in arbitrage is that you have an asset that is overvalued and you think you know it's overvalued, you're going to earn money by selling it. When enough people start selling it, what's going to happen? The price will calm down. That's the equilibrating tendency. People profit by arbitraging away this price spread between the real price, which is lower in this particular case, real rate of return, real price, and the current price. People sell and they earn the difference. In 1 month, the price will be far lower. And I'm better off by selling right now. So that's how equilibrium is restored. Just as in any other market. What happens if you have, what would be the opposite situation? That you have a low rate of return, low mean, by high variance. That's a real situation. That's a reality. You know, you have any information, you think that that this is what is happening now. That would mean that people can you explain? Here we had the high mean and artificial. Overestimated the risk. So what you do then, if the risk is overestimated? Yeah, buy. Why? Because when it's realized that the risk is overestimating, what's going to happen to the mean value? It's going to increase. So that's the arbitraging away the differences between current prices and the real prices of every particular financial asset. And the key in all situations is the specific knowledge that specific people have about the future prices. Not everybody has the perfect information at every particular moment. One more thing here is that past prices are irrelevant for the assessment of these things. So the past price behavior is irrelevant for the assessment of the value of financial securities. Financial markets are always prospective rather than retrospective. What does that mean? That means that they use the best available knowledge that we have right now to predict what's going to happen in the future. So when the stock price of some company increases right now, that's not a kind of pat on the back, you did very well in the past, Mr. Bezos or Mr. Gates. No. It's an actually expectation that in the future that particular company will do well. That's what is meant that the financial markets are prospective. Stock and bond prices are actually current consensus estimates of the financial community of investors about the expected future behavior of these stocks, future expected returns. So I gave you this example that the Amazon Corporation for the first 6 or 7 years of their career didn't make profit. They were losing money. And yet the stock prices were increasing. How was that possible? It's a very simple reason. That the investors who understand the business, they thought that Mr. Bezos knew what he was doing and that he will turn out profit eventually. Yes, he did. So see, the current profitability statistics and the current or past profitability statistics are not very good predictor of the future profitability. That's what it means that past security prices are not very good guide about what is going to happen in the future. Okay, now the key. These two theoretical principles. They are the key proviso, the key assumptions of this whole thing. Financial markets, including the portfolio diversification, hedging, reducing your risk exposure, and so on. Efficient market hypothesis means essentially, you can translate it in very simple terms. There are no financial bubbles. No bubbles. That's one way of defining efficient market hypothesis. The second way of defining is to say that the market is efficient insofar as the asset prices, stock, bond prices, are based on the best available knowledge that is currently available. And the second aspect of this, even if the market is wrong temporarily, it's very likely that it's going to get corrected. So market is a self-correcting mechanism. Even if it gets something wrong, it's far more likely than not that it's going to correct its mistakes. So these two components are very important. The first one, that it is the knowledge aggregator. That Eugene Fama took from F.A. Hayek. That's one of the weird things. These two schools of thought are not friendly. The Austrian School of Economics at Hayek exemplifies in Eugene Fama Chicago School. However, the crucial insight that Hayek developed, you remember when we read the competition is a discovery procedure and so on, it said that the market process is a system of aggregating and collecting knowledge of millions of people that no one individual can accumulate herself. And this knowledge about characteristics of different things are crystallized in prices of assets. He says that the market prices are based on the best available knowledge. They're market prices and market mechanisms are very efficient in collecting all best knowledge that all most knowledgeable people, competent people in the field have. And the second thing is that even if they make mistakes, the market is a self-correcting mechanism. If that's the case, then you shouldn't expect markets to make big mistakes that will last for a very long period of time. You shouldn't expect that the financial assets could be mispriced, which means inflated in value or deflated in value for a very long period of time. If it's a self-correcting mechanism, then you can get a mistake, error, but then you correct it, the price goes down. If it's overvalued, the price will go down quickly. If it's undervalued, sooner or later somebody will discover that and the price, as in these examples, will go up. And on average, you will have this efficient long-term equilibrium, which nothing dramatic happens. So that's the idea. No financial bubbles. It means no systematic and long-term mispricing of financial assets. Mispricing means overvaluing or undervaluing. Why is this important for the portfolio theory and the risk management? It's very simple. The assumption of the portfolio theory, as you remember, is that the likelihood of the price variation and risk variation is not correlated. You buy one stock, that doesn't affect the likelihood of another stock going up or down in price. One of them goes up, another one somewhere else will go down, but it's a wash on average. Just like in the insurance business last time, you remember, for insurance business to function, the risk of my house burning down has to be uncorrelated to the risk of your house is burning down. Because the insurance business is based on the model of large number of low-risk people paying small amount of money to compensate somebody whose house eventually will burn down, somebody's house, unfortunately. So what's going to happen then if the risks are correlated? If they're not independent, then it cannot work. The risk premiums have to be much higher then. And its risk premium are high enough to exceed or to equal expected costs for everyone involved, then nobody would buy insurance premiums anymore. So if we all live, the entire group lives in some forest fire prone area in California or wherever, then there is a systematic risk. We are in the same neighborhood which is affected by forest fire. The risk of my house burning down is not unrelated to your risks. When the risk for my house increases, the risk for you increases as well. So you have to eliminate this systematic risk correlation if you want to do the insurance business. Something similar happens here. If there is a factor or a set of factors that affect the stock prices or asset prices all in the same direction, then you have a problem. So for example, if we are in a financial bubble and then the bubble bursts and the stock prices go down by a third, as they did in 2008. What would that mean? That means that your portfolio diversification is not a quasi-insurance anymore against high risk. So like portfolio diversification is a quasi-insurance. It's similar to insurance. You insure yourself against insure yourself against high risk of investment. But if the riskiness of all securities is systematically undervalued, then it's not any good, actually. You're going to be losing money eventually. Everybody, if you lose money on everything. And that's what happens in a recession. Financial crisis, financial panic. All stock prices go down dramatically. So it doesn't matter what you put in your basket. If the basket falls to the ground and all eggs are broken in all three baskets that you have, it doesn't matter that you didn't put all eggs in one basket. If every basket goes down. So that's a problem for this efficient market hypothesis, that there very well might have been financial bubbles. Sometimes they happen. And if that's the case, then optimal investment portfolio theory is not good enough anymore. It doesn't mean that it is wrong. all of these things that I told you. That's completely wrong. But it's limited. It's limited to good economic times. It doesn't help you understand the total picture of risk because it doesn't account for the possibility of financial bubbles. So financial bubbles lures you into a false sense of security and mispricing risk, putting a too low premium of risk, underestimating the underlying risk. Remember the mortgage-backed securities that we discussed. That houses were considered to be an absolutely secure investment. And then what the banks were doing, they were selling the loans, mortgage loans, to investment banks and other Fannie Mae and Freddie Mac and other private investors in America and all over the world. And they would then combine different loans, some of them very good, some of them like a ninja loans, no income, no job, no assets, subprime loans, and you combine them all in the same, in one security, in one bond, and you then bet that they cannot go all down at the same time. Maybe even if the subprime loans go belly up, it will be more than enough money. You can earn more than enough money on those other loans, so your security will not go. But what this didn't predict actually is the prices of the entire stock start going down. The prices of real estate start going down. It doesn't matter. Eventually, then it just exacerbates your exposure to high risk investment. So it's correlated. People made a bet that the prices of these different types of mortgage loans are not correlated because they were considered those more secure loans were maybe 50-60% of the package. But when the price of real estate started going down, it turned out that the level of risk was higher than previously thought. So that's one of the limitations. One of the problems with this theory is that there are some reasons to believe that markets are not efficient in the sense that there are no financial bubbles. There are no longer or shorter periods of systematic mispricing of financial assets, overvaluing. So it's not a random walk. That's Eugene Fama's assumption. The markets just go flip up and down around a certain mean. It increases. Sometimes it goes down slightly. It goes up, but nothing really dramatic happens. No boom and bust cycles. Other theorists, such as Hayek, many others, believe, there are financial bubbles. That's the problem. Now, Eugene Fama can respond here. Please define a financial bubble for me. How long should it go? Can you test the empiric of a financial bubble and say this is a financial bubble? How to recognize one when we see one? So efficient market hypothesis admits that the financial assets might be priced wrongly for a short period of time. And then, how long should it be in order to qualify as a bubble? So these are more complex issues and more technical issues of financial theory. We don't have a time entering into that right now. If you're interested, I will post on Canvas a discussion between Eugene Fama and Richard Thaler, another guy who believes, like Hayek, in the financial bubble. So they were like spending like 25 minutes discussing how to define a financial bubble and how to test whether there is a financial bubble on the market or not. So if you're a freak enough like me to watch that, I will post it on Canvas with you. Any final questions?
There's no homework this week.
There was no homework this week. I sent you the Canvas announcement, so don't worry about it. There will be the last homework assignment will be next week. Okay, good. See you Wednesday.
Thank you.
See ya.